securing portfolio loans
Okay.
from a private lending perspective. And this is really an interesting one. We actually did a deal quite recently on this. And what's really cool about this type of loan is this is where you're securing multiple properties at once.
This tool is where you get into the position of being able to really grow once you have a bunch of properties, because you can't expect to just like be refinancing properties left, right, and center constantly. Like, it just wouldn't make any sense. So sometimes you have equity built up in 3 or 4 different places that you can tap on and utilize to then make a single purchase, right?
Yeah.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 46 of the Canadian Private Lenders Podcast, presented by Mortgage Automator, with your hosts Ryan and Neal. Neal, how you making out?
Pretty good, sir. Little sore. Same thing I also always say every time. Now it's my shoulder, my knee, and my back.
Oh, I got a sore shoulder too.
Yeah?
Got some needles into it yesterday, some dry needles.
How's that?
Makes a huge difference.
I should go. I got to book that.
Yeah.
It's a full-time
absolutely.
job taking care of your body.
Yeah. Especially when you get to almost 40 like me, buddy. You wait.
I went
to another decade to go, but
I went to a 30th birthday last night, and I could tell he was bittersweet.
yeah.
Even if, Chandler, I don't know, he doesn't listen to this, but Chandler's 40th too. It's a bittersweet like turnover point whenever you go from the previous decade to the next one.
Yeah.
You're like, oh, this is cool. It's a big birthday. And you're like, wait a second.
Yeah. I got about a year and a week until my 40th. So yeah. I stopped caring about birthdays a long time ago. So
yeah, true. I get that.
But yeah, it might be a rough one.
It'd be all fun. Like, wait a second.
Yeah, 40 seemed really old when I was a kid, and my parents turned 40. I can remember that, but it's
this
funny.
Is man.
It doesn't
life,
feel old now that I'm almost 39, but anyways,
life is weird. Like I'm same here. I think about that, and I'm like, when I look at myself, I'm like, damn. I remember looking at me. Like even like 10 years ago, I'm like, damn, he's kind of getting up there. And I'm like, I'm now there. Wow. Okay. That happens. Like anyways, life's funny how it passes you by, but
it is.
I'm the same as you. I got about a little bit over or a little less than a year before my 30th. So I'm going to host a big party. I'm sure I'll be having a good time.
I think you will.
But we'll see. Okay. I have a news article for you today. I'm going to read you the headline and see. Okay. I want to read it to you and see what you think. Despite first quarterly loss in 21 years, TD sees strong mortgage volumes in Q3. What are your reactions?
First loss?
In 21 years. We're talking
what
2008.
Caused the loss? Write-downs.
So, okay. So this is, and I was like, when I saw it, I was like, whoa. That's huge. No. So it was TD putting away provisions.
Yeah.
Because they're in a lawsuit.
For losses.
Okay.
For
a lawsuit.
Stop interrupting.
For a lawsuit.
Okay.
So they're in a U.S. anti-money laundering case right now.
Yeah. We touched on that before.
Yeah. And so they just put away $2.6 billion. I also then was sitting there and I was like, damn, these guys are making $2.5 billion a quarter profit on the books, which means they're probably actually making more like $5 billion.
Yeah.
So they're making like 20, 30 bill a year profit. These companies are gross, man.
It pays to be one of the big five.
Damn, that is insanity. Wild. Anyways, when I first saw it, they got me because I was like, whoa, 20 years? Like, yeah. So yeah, anyways, there's an anti-money laundering lawsuit going on. We've already talked about it. There's a crackdown on all that stuff taking place. I actually heard something interesting about 2 days ago on another podcast. It was actually Steve-O from Jackass?
Yeah.
So it was Steve-O's podcast. He does that out of the back of his van.
Okay.
And he had, you know who Dan Bilzerian is?
Yeah.
So he had Dan Bilzerian on there. And if there's any females listening, I feel like they're immediately gonna be like, yeah, of course, this guy was. Yeah. I think Dan's interesting because I find he's so he's just open. Like he's open book, he's blunt, he tells it how it is, in my opinion. So I was just curious to hear what he had to say. And Steve was also not afraid to ask hard questions. And so the hook that got me is Steve-O basically his promo clip for the pod was him asking about Dan's companies and all the losses that they're facing. Not lawsuits, but like the physical dollar losses. And so he went down that path. And then they ultimately got into Bitcoin and what his take was on that. And he felt that like cryptos were going to take over, and we're already kind of going there. Where I'm going with this whole thing is it actually makes sense for money laundering. Like he was talking about how we're kind of there now, but it's why there's anything but electronic forms of cash or money moving around. because that's where this stuff starts coming from, right?
Yeah.
Is when they can't fully trace it. And he's like, that's where crypto would make a ton of sense for the banks and the governments, is they can really trace it all the way back. I wonder if and now as I'm saying all this in my head automatically, I'm like, why would the bank be opposed to getting into this? Because if they really wanted to, if you're making $10 billion a year, you can make these currencies come on pretty quick. There might be a big part of their business that they're like, we're concerned about losing, because I've always said, I feel like the banks know that not everything's above board, but it's like, as long as it keeps the book moving and growing,
Of course.
they go
look
with
the
it.
other way. Absolutely.
Just don't give them a reason to look at it.
Yeah.
And they're happy.
For sure. Well, it's interesting. I wonder, do you think it would lead to layoffs and cost cutting based on that? Or do you think it's just a one-off where they just, the market doesn't overly react to it? I didn't see how TD's stock price was affected by it.
Quote the TD stock on here.
It was likely already baked in too, right? Because this news came out months ago about the anti-money laundering.
Yeah. I mean, technically, yeah, there probably will be some like, they're going to have to watch a little bit. Like if they're putting aside basically $5 billion to pay a bill, they're going to be like, okay, well, we need to make this money back up, especially when you're publicly traded. Yeah. Like there's a lot of expectation for you to continue to make a certain amount of money and to return a certain amount to your shareholders. Yep. So yeah, they'll probably start looking at other options for cost cutting. They're also being aggressive, they said, in growing their residential lending portfolio. So that was up 6%, which in a quarter that's a strong growth, especially like what these guys are talking like hundreds of billions of dollars out. The other thing that they showed that was interesting, the other two things in this article that I liked was, and I mean, this opposes Neal's negativity. First was they showed their maturity schedule.
Mm-hmm.
And so they have 5% maturing remaining this year. Makes sense. 22% next year, which is like, so a quarter of their book is going next year. And then 32% is 2026 and 30% is 2027, which presumably by then rates should be pretty reasonable. And they would actually be very close to where people would have been within their stress test. Because if people are taking, I think the lowest mortgages were like 1.8, was it? Or was it like 1.2 for people?
There was some variables that were like 1.25, I think.
Okay.
Fixed was probably as low as, there's probably some discounts at 1.5 or 1.75.
So let's say 1.5.
Yeah.
So you were stress tested, it was 2%.
2% above that, yeah.
So 3.5%. You can still by in another 24 months, you'll probably be able to I would imagine, be able to get that rate.
Mm-hmm.
So based on this, we're actually kind of trending in a decent position where all these maturing mortgages are going to be in a position to get renewed within their stress test. And so theoretically, it shouldn't actually be that huge of a blow on the residential side. Again, the commercial side, that's a whole nother conversation. We should actually talk about the commercial maturity for mortgages in the States. That is a huge item that they're talking about, is the next 2 years of those coming due. And it's a shitstorm. Predominantly, firstly, because they can't afford them. Secondly, because on top of that, like office spaces have emptied out, the commercial market is softened. So there's a bunch of other factors. The last point I want to make on this article that I saw that again is a positive thing in my eyes. They're talking about their amortizations on people's residential mortgages and the percentage breakdowns. And if you guys remember, during the rate rise, because it happened so quickly, we talked about how people's mortgages went from like, it used to be capped at 25 years. Then it was like, people were like, I had 47 years, 85 years. And then we had someone send in a photo or saw a screenshot somewhere of one that just had an infinite symbol. Like it just never getting paid off.
Right.
And so in Q3 of 2023, 23% of TD's book was showing an amortization of 35 years or more, which is huge. That's a quarter of their book was completely offside.
How does that compare to previous quarters? Do you have that?
They don't have previous on here.
Yeah.
But I think a more normalized would have been like 5 to 10%. By this year, Q2, they had it down to 16.5%, 35 or more. And now in Q3, they're down to 13%.
Okay.
So they've already cut 10% of the book and they've pushed it back into standard amortization sub 30 years. So all these things in my eyes, I'm like, this is actually a fairly positive like cleanup. Like there was a temporary blip there from Q3 2023 to today, where there was a lot of pain and a lot of concern. Yeah, but it seemed like they're able to get it all back on side. Yeah, and like with a couple more rate drops, I'm sure they'll get that 13% down below 10. Yeah, like if they're dropping that quickly.
Yeah, we talked about this with Dave Carter when we were in Toronto there a couple of weeks ago, but I don't see major pain coming for the banks on the res side.
No,
right?
It's all the commercial ones.
Yeah.
Now, keep in mind, I mean, most of you probably know this, but their commercial book's quite likely a fair bit larger.
Is it though?
I think so. I guess it depends on. I guess some of
deal
these banks
size would be, but I don't know. I don't know.
Maybe not. Maybe not. I don't know. I guess it depends. Like, I guess it depends on the bank. Some banks push it more than others. I feel like TD is actually definitely more res facing.
Yes, that's what I was going to say. I think TD, just from what we see, where they participate in the broker space as well.
Yeah,
I don't even know people who have done commercial through TD, so I'm not sure they're that big. I know BMO is bigger in the commercial space. RBC is bigger in the commercial space, but I don't know. I don't know if it would actually represent
a larger portion.
Yeah, I don't think it would be a larger portion.
I'll look into that. I'm actually super curious now that we said that.
I've been in the private lending game for a while, and let me tell you, Mortgage Automator is the ultimate software for private lenders. It's been a total game changer for our business. I've scaled 2 private lending companies, and I couldn't have done it without this software. The Mortgage Automator team truly understands the challenges we face, and they're constantly thinking ahead. For example, they've developed new anti-money laundering and know your client tools to keep you compliant with the latest FinTrack regulations, and their platform is SOC 2 compliant, ensuring your financial data is secure. This software eliminates almost every admin burden you can think of in the private mortgage business, saving us thousands on staffing costs. No more manually typing term sheets or tracking files in Excel. So whether you're a new private lender looking for an efficient solution or an established lender aiming to scale up, Mortgage Automator is a solution for you. See if Mortgage Automator could be a good fit for your unique lending needs at www.mortgageautomator.com/switch. Let's jump into today's topic, Neal. So we're going to talk about securing portfolio loans from a private lending perspective. And this is really an interesting one. We actually did a deal quite recently on this. I've done a bunch of these historically. And what's really cool about this type of loan is this is where you're securing multiple properties at once, right? So often it's like an off-market deal where you've got maybe an aging real estate investor who's looking to sell off a portfolio, and they don't want to go, sell piecemeal like 1, 2, 3 properties at different times. The ideal situation is just to bulk them up together and sell them to one investor.
Yep.
But that could be challenging too, right? Someone coming in, you're talking, $1 million, multiple millions of dollars to make a one-time purchase.
Yep.
So you really have to have the right lending partner with that. You've got to have the experience to back it as well, and some sort of liquidity to be able to support that or make the down payment on that. But we're going to talk through how we put this one together, and obviously, I'd love to pick Neal's brain a little bit here about his experience doing this as well. But basically, in summary here, you're often looking for properties that are bulked together, often in the same geographic area, could even be on the same street. This particular example is essentially on the same street or same street corner. And as mentioned, these are often off-market deals where the buyer might have even negotiated a lower price based on the volume being sold all at once.
Yep.
So before I get into the example, Neal, why don't you kind of touch on, I know this is how we initially met actually, was from you basically tackling a street of Halifax properties, and that was, maybe a bit run down, but that you've put, let's say, a couple hours into over the past couple of years.
Yeah, I've spent my life on that street. This was something that I did. I didn't know what I was doing, but I learned very quickly. And we've touched on it a few times because it's a great example for a lot of different types of loans and what you can do. But it was a street of 7 properties. And there was about 3 different sellers. And where it really started to play, that it became a portfolio, is I bought the first building, then I bought the next 2. The last 3 that I ended up buying were owned by one seller. And same thing, he didn't want to do them individually, which, I mean, I get it. But at the same time, like, he definitely could have got more money if he put them one at a time on market and went through the process. But I was in the midst of these other projects, and I was closing some of them out, and these came up. He wanted to sell them all at once, which was a little bit above my ability to close at the time. And so we were able to take on basically a portfolio loan, which was, we went across the 3 properties that I was securing, the 3 properties I was buying, and then we secured the other 4 properties that I had next to it that all had equity in them, that were basically complete. There was a mixture that were complete and maybe 1 or 2 that weren't. And we were able to basically utilize the equity and carry it forward into buying those other ones, as well as, again, it was secured against the whole process. And again, it worked well because you guys had security on everything already. So we were able to blend it into that and create a nice loan that gave me access to cash, the buildings, and push all the way through the project, which was really nice. And again, I think this tool is where you get into the position of being able to really grow once you have a bunch of properties, because you can't expect to just like be refinancing properties left, right, and center constantly. Like, it just wouldn't make any sense. So sometimes you have equity built up in 3 or 4 different places that you can tap on and utilize to then make a single purchase, right? And that's what it was for me. It was again all in one street, but into the point of geographic area, like we would look at like a town or even within like a certain city, as long as they're in that same wheelhouse. I think it's not different provinces or like spread all over the place. In the commercial world, though, I think they get into the bigger things where it's like provinces and all over the place. So.
Yeah, we've even seen some too that are across multiple provinces as well, depending on, and that's typically maybe more of a refinance scenario than a portfolio purchase.
Yeah.
But this one here, to your point, Neal, this is really a great way to accelerate the growth of a real estate portfolio, right? So, chances are you probably don't want to do this as your first purchase into real estate investing, but this particular borrower owned a couple properties already, was experienced in renovations, and just saw this opportunity and tackled it. So let's run through this deal example, okay? So as mentioned, the borrower was a seasoned real estate investor, and he had an opportunity to buy basically 3 duplexes on the same street in Windsor, Nova Scotia. The other additions to the deal here is that he had another 2-unit build that was in progress. That it was basically a bungalow that he was lifting off the ground to create a second unit in there. Yeah, really cool. So that was, call it 65, 70% complete. And he was looking for funds to finish that as well, but it had no mortgage on it. So that property was free and clear, maybe worth $250, $300 at the time. The particular borrower also had a very good income as well that had good cash flow coming through. So we were able to confirm he could support payments on this as well. And we also got additional security on the personal property in second position. It was a higher value property, had a big mortgage on it, but we were able to secure that property basically as a sign of goodwill from the borrower. Same as we would have done with you, Neal, years ago, going through this the first time with the borrower. Often we're looking for security on a personal property there as kind of that goodwill to say, I'm not going to mess this up. I got a lot on the line here. So anyways, so just to go through some additional details here, the client's credit was average to good, basically based just on high utilization, perfect repayment history. We don't really care about credit score if it's, just banged up a little bit based on, utilization. That often happens with real estate investors where you're stretched out on multiple trade lines.
Complete aside, but that one is a little weird to me sometimes, because that's what I got beat up on, was high utilization. I'm like, but I've never, like, it's only perfect.
Yeah.
I feel like that's like a good thing almost. Like, that should show you credit that like you can carry a lot and be fine.
It is for an alt lender perspective, especially private lender perspective, to show that perfect repayment history.
Yeah.
But,
for regular other places,
the banks look at the box, right? You're not a 750, then you're out. Go somewhere else.
Craziness.
Yeah, it is. So basically, total purchase price was around $850,000. Appraised value was significantly higher. It was just over $1 million. So client basically got a $150,000 discount by buying these in bulk.
Yeah.
And we gave the client the whole thing. How about that? just over $1 million in financing. So, and that might sound surprising to some people that we would do that, but there's obviously a multitude of reasons as to why we did that. Primarily, as I mentioned, we had additional security. So our loan to value wasn't just based on this purchase.
Yeah.
We attributed some value to the higher value there versus what he actually purchased it for. The other property, one of them was free and clear, like I mentioned. So there's a lot of equity there. And we had the personal property, as mentioned. So our total loan to value actually worked out below 70%. It was about 68% loan to value across the entire portfolio.
That's the important part to hear here.
Exactly. Yeah. We don't just provide, you purchase it for $250,000. Here's a loan for $250,000. Have a nice day. That would not be a great strategy in the private lending side. We do require that equity buffer, of course, but where this was a seasoned real estate investor who had these other assets to pledge, it really eased the down payment requirements for them.
Yeah.
Right.
This is where having the portfolio starts to really bode in your favor outside of just cash flows, having the equity.
Yep.
The other thing that popped in my head is, like, when you look at REITs, this is literally how they do their business. They're not like refining each and every individual building, but they're doing portfolio loan from 20 buildings that they have over here that are in a good position.
Totally.
To then carry that forward and close on the next 20 buildings.
Yep.
And temporarily, those 20 buildings might be underwater a little bit. And then they slowly stabilize them over 5 years, and then they take that out and move it forward. It actually can be, if you can think like this instead of individual deals, again, you have the opportunity to have a lot of growth. It might be in different stages. So instead of buying a building every 6 or 8 months, you might be buying a package every 2 to 3 years, but you actually probably are still outpacing the growth that you'll be having in doing the one-offs.
Yep, absolutely. And just to wrap up this one, exit strategy was very solid on this one here. So basically, it was a timing thing where the borrower needed to close in a short amount of time. Properties just require some cosmetic upgrades. They weren't in rough shape at all. Although we have done this before for properties that are in rough shape as well, as long as the equity's there.
Yep.
And once those upgrades are complete, client should be able to refinance out with the credit union and pay out the proceeds of the loan.
Easy loan.
Nice and easy. Easy way to put $1 million on a couple properties, right?
Get a portfolio, and then you can just buy another portfolio.
There you go. There you go. I mean, that's it in a nutshell, right? Like, just like you said, this is how real estate investors scale up their portfolio, is by leveraging what they have. And obviously you have to start somewhere.
Yep.
But as you scale it up, chances are you're going to be able to build some equity there and pull that out and apply that to make bigger plays if that's your strategy.
100%.
Anything else you want to add, Neal?
No.
That's all. That's it.
That's all. That's it.
All right. Thanks everybody for listening.
Thanks for listening.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.